We have something developing that we have not seen in some time, and it's really important for us to get that we do have a shift. We're going to spend a lot of time on this today, specifically technicals and actionable things. In other words, I really want to drill into the charts. I really want to spend a lot of time on this today. I have some other fundamental and macro stuff I think we should really cover, but we really need to dive into this. So settle in. A lot of this is going to be really technical today, and it's also going to be pretty actionable going into next week. And I think that's the best thing that I can do for everybody right now. So let's just jump into it. In front of us, we have the S&P, and we note that we have a completely different topping pattern that we've had in the past. We can all see it, right? Irrefutable. And the first thing that we should just start with the S&P and how I view how this is playing out, and I think this is really important for us to get. You opened at the high, and then from there, to put this little magnet on, and then you closed right near the low. And it's not an exact low. And if it was, it's something called a black Marabuzu. Bear with me, I'm getting through coffee as I'm doing. And what's important about that is it's about as negative a bar as you can get. It doesn't really get much more negative than that. As a matter of fact, if you go through and look at this chart, it's very rare that you're even going to see them. Even TradingView has a way of spotting them on a chart, and you can see it pretty clearly where they have something called all candlesticks, and they'll actually point them out in the patterns. But what you want to take away from this is the over and then the under, and the encapsulation, and we're going to zoom into this, and I am going to go through different time frames today. But what you really want to pay attention to is this, and it's super detailed today, guys, so settle in. You might want to watch parts of this again. What you want to note is that you've come over the top, and then you've encapsulated 1, 2, 3, 4, 5 days in a row. So all of this has been negated. Forget the gap. We're going to get to the gap in a second. But when we came in Thursday, all of that was negated. So the very first thing that you have to take away from this when you see it is, oh, this is a problem. Now, you did get signs of a problem that started, and how could you tell that they started here on the 29th? You see the gap up, you see the encapsulation of the bar. This is super important to get, because the encapsulation of this bar, while it's important, it's not really an engulfing, but what it's telling you they're doing is they're looking for that FOMO. They're looking for please reach, so that we can just dump on you. And that's exactly what they got. As always, subscribe to the channel, click all notifications. What we go over here is extremely timely. It helps greatly with the channel. I specifically do not run ads, and that does not help me overall with the algorithm that I don't do that. So subscribing does help, and I'm trying to grow this for a lot of different reasons. Specifically, I want to start having guests on, and I want to get to a certain number before that. And I just want to start getting economists on and other people on here. So the faster I build that up, the more appealing it is to them, obviously, for their exposure. But let's get to this and get back to it. So if we look at how this whole thing played out in here, what are we noticing? All right, so we have this, right? And then we have the encapsulation here. Okay, so I'm going to take all this off for a second before we even get into the moving averages. And I just want to go through this on an hourly, because I do think it's really important for people to get this. And not everyone needs to look at hourly charts, and we want to stay really looking at the whole picture today. But I do think we need to just kind of pay attention to this. So we're starting to see that behavior change, right? The first hour and then the drop. The first hour, they're buying, and then we're starting to get buying in here, even on Friday, and then we start seeing the change on Monday, and then we come into Tuesday. Now, what's interesting to me about Tuesday, and why I want to do this, is because you're getting signals. So the same signals that you get on a daily chart, you usually get on a shorter time frame chart ahead of time. So the signals that you get on a daily chart, you usually get on a shorter time frame chart. And I'm saying it twice on purpose. So what do we have here that you're noticing? Well, the first thing that you have is this encapsulation of everything that takes place right in here. And so you have this complete encapsulation on the hourly of what transpired. And then what you're getting is a follow through here, and then go, okay, well, let's look at this on a 4 hour. And you'll see what I mean. Oh, okay. So then we get the 4 hour that completely encapsulates everything. And then we go to the daily, which completely encapsulates everything. So a lot of people that are in the community were asking me, because on Tuesday, I think it was the 29th, on Tuesday, I closed a lot. We had a lot of like live trades on in the community, and I closed a lot of trades. And the reason I did that was because I'm like, yeah, when you go up and over, and let me clean this off again, we'll drop it to the hourly. When you go up and over like that, you're grasping. Now, the second thing that I use to determine this, if I go and take a look at the RSI here, you will note that the RSI is sloping. And I have videos on this where I've done this in the past and explained RSI. And here's the thing that you need to understand about RSI. And I don't want to get too in-depth in this because I am going to do a whole video on it, but I just want you to understand the reason that I like RSI is because RSI determines the magnitude of the move. And so what it's telling you is, hey, what's the magnitude of the move? Meaning, is the magnitude positive and going higher? So when you see these divergences on longer time frames, I know it's unsustainable. It doesn't mean I can't flatline and drive everybody crazy, but it does mean that I'm in a situation here where it's just not feasible. Like, you're not going higher for a very long period of time if the magnitude that's driving you is not getting there, right? So like if you're in a car and the car starts slowing down, it's going to take longer for you to get there. Just think of it that way. It's just not realistic that if the magnitude slows down, you're going to get there. And I can get really into this if you guys want. If in the comments, if you want a copy of the book or you want me to give you the link of the book, it came out in the 70s. It's by Wilder. And you can actually read how he calculates this thing through directional movement. And it makes a ton of sense. It's also why I changed my RSI settings. And I'm surprised. It doesn't matter. I'm surprised he used just the close. I don't use just the close, and I changed the time frame, but whatever. That's why when you look at them, my RSI looks different than probably a lot of people's because mine's better. But if you take a look at this, you're seeing up here, right? And once you get that lift over, you see how it's sloped? And now what you're starting to see is now you're starting to see that underslope too, right? So if I just went here and clone this for a second and drop this down, and as I stated when I started this video, you're going to spend a lot of time today getting super technical because there's a lot going on here that we really need. And so now you're getting this under as well. Some might even look at it this way and go, oh, well, this is and to an extent, yeah, it is. And it's at the top of a chart, and we need to pay attention to it. The question is, what's going to turn this around? We'll get into some of the macro stuff that's a little nutty that's going on right now. We do have to cover some of it. But what I have is I have a megaphone at the top of a chart. We haven't even gotten into the moving averages yet. We haven't gotten anywhere yet. And already we can already see that we have this suck salad to deal with. And it's not great because the undercut was followed by what? A huge rally up, which is doing what? Creating demand that doesn't really exist. Why? Because they have that much supply that they want to dump. And in and of itself, you know what? I'm going to get the smart money, dumb money because of the change. I'll pop smart money, dumb money in here the more I'm thinking. In and of itself, when you see this, that's a problem or a blessing. It's a problem unless you're net short. Now, you follow through with the gap. And then after you get the gap, here's your RSI down here, and you're like, oh, well, we're going to be fine because we're already oversold. Not really, no. Here's the megaphone, here's the break, and we're not even oversold on a 4-hour chart yet. So can you rally up and then attempt it and go from there? Yeah, but when you start looking at this on a 4-hour chart, it's a problem. And so for me, that is number one. We can get into the other sides of the stool and really dig into it and say, okay, well, we have the macro side of it, which non-farm payrolls, which we will cover briefly, is definitely an issue. It's definitely worse than it appears. Obviously, the person that was running it is fired. It's interesting that they had the biggest missteps between 24 and 25 that ever in the history of the data, and that's just factual. But whether or not it's on them or not, that's another conversation for another time. We'll do like our tinfoil hat, after dark, Arete after dark, I guess. But for our purposes, the fundamental side rocked. We absolutely crushed it. And we're going to have to address Microsoft, Meta, Amazon, Apple, and what's really going on there because long term, we're good. But the macro side of the market, when we're seeing inflation go up, which it is, I don't really care. Facts don't really care about your feelings. And we're watching labor implode. It does put us in that market where it's like, okay, well, what do we do? Do you cut rates? That's going to be the pickle. And I actually think if he had the non-farm data, he might have done that. All right, let's get back on top. And here's the topic. Macro. What do you have going on? You have some real issues out there that are affecting the market. Fundamentally, we're killing it. We're absolutely killing it right now if you look at earnings. Like they were just crushed. But you've come pretty far pretty fast. Technically speaking, when you look at this, you cannot be feeling warm and fuzzy. And we're going to dive really, really into this. So now that we got that out of the way, if we look from here and before we dive into anything else that we should be looking at, and I'll give you a couple other things that I use to determine whether or not this is even close to stopping. The very first thing that you have to look at is the significance of the drop and how fast you dropped on the RSI. And that to me is pretty telling, because that is, let me lock in my quarter, lock in my month, and get the heck out of the way. Now, we can get into support levels where I'm showing you those support levels and saying, okay, well, you held this area and it looks like you're going to hold, but what are we really seeing here? And this is where I think you have to kind of take a step back. We're going to get rid of the RSI for a second, and then I just want to drop in, and I'm going to get rid of the volume because I really don't care. Because obviously the volume's picking up and we all say it. So then we're going to drop this down and say, all right, well, what do we really have? Well, you have an area around 61.54 that maybe we're going to hold, and maybe by the time this moves up, and you can always count how this is moving. It's not this linear, but if I go here and I go 61.0941, and you can see the number right here, and I go over like one day and you go like, okay, 61.02. All right, so I'm moving 8 points a day. So if I'm moving 8 points a day and I'm at 61.10 and I've got 40 points to go, then you know within what? 5 to 6 days, and again, it's not linear like this, but within 5 to 6 days, I'm going to be touching the 50-day. So by next Monday or Tuesday, you might be getting a test, not this Monday, Tuesday, but the next one, you might be getting a test of the 55. I use a 12, a 22, and a 55. I'm going to explain how I use them as demarcation lines in a second here. Some of you have heard this before, but I think this is super important to get. You did something that you haven't done since the tariff. And if I click off these levels and just look, to get here is not going to be an issue. Like, I don't see how you're not getting there, is really where my head is right now. I just don't know how you're not going to test this. And so what does that mean? Does that mean the sky's falling and, you know, rates are going to drop and this is going to happen and I have to change everything? Maybe, or maybe you could just realize that the market has volatility associated with it, and that if you look at that volatility, you should actually probably be making a buy list. So first actionable thing that you should take from what I'm going over today is not try to predict the next great financial crisis, because if you did that, you were right twice. Once during the pandemic, and the other time was the great financial crisis. For the people that are still sitting there trying to figure it out, you're better off in environments like this understanding, yeah, it can get a lot worse. Yeah, it's expensive. But what are the names that I would really be interested in buying? I'll go through a couple, but I would just go take a look at the earnings reports that came out and just say they're the ones that I want to buy, like the ones that absolutely crushed. And we are going to go through a couple of those. But I think you need to get this first before, and then we're going to look at smart money, dumb money, and tie the whole thing together with institutional order flow. But take a look at this. All right, so here we have the SPY, and I spent a lot of time on it on purpose. And then we just look at the test here on the 22 and the rejection, the test here and the rejection, and then the flip over. So why did this flip happen? Why did we flip? We flipped because we paused all that liberation, right? We got all that liberation out of the way, and then we paused our liberation, and then we closed above. From there, we have never closed below the 22. Not once. We've tested it, but we are completely closed under it. And the worst part of it is they opened us on it. Now I'm looking at the S&P. I'm not looking at futures. They opened us on it, and then they gapped us down. They never, ever got back there. You have 3 to 5 days to get over that. And if you can't do it 3 to 5 days, you have a problem. And what I want to really explain here so that people get it, you had a macro event that created this bar. It's not somebody that's showing you some new pattern on, you know, Twitter or YouTube as to why the market did what it did by their new indicator. It's not the guy that's telling you to buy, you know, zero dated options on Friday because he killed it because he's a super genius. No, it's a macro event. You had a non-farm payrolls number here that was significantly worse than expected. And on top of that, you also had these tariffs that are significantly higher than expected, and they're going to pass through those costs. We're going to cover some of that. But it's important to understand what did this and what did this. So what paused us here back in April 24th may be unwinding here because we had the pause, right? Remember, we're going to be liberated, and now we're breaking out, and now we're coming back to it. Why? Because they're putting them on. Wash off, wash on, right? Just like the Karate Kid. So if you get that, you understand that, oh, the reason we're moving is because the thing that we've been pausing is actually creating deals. And when you understand that, it starts making a lot more sense. So the reason that we paused here and went higher was because they paused all the tariffs and there wasn't anything that was really going to take place. Fast forward to 90 days and all these being put on and the economic data, that's why we flipped. Now, I use a 12, a 22, and a 55, and I'm going to explain exactly how I use them. So, and you could use whatever you want. Some people like an 8, a 10. It doesn't really matter to me. There's reasons why I use these. I'm not going to bore you with them. And I tend to like the open, high, low, close when I use these averages. But if I am below a 12, to me, that is, do I want to trade the market or not? Very simple. Do I want to trade the market or not? It's very simple to me. And it might mean that, yeah, I still do, but I'm cognizant of the fact that I'm below it. So if I close on the 12 and I'm below it, but I hit the 22, bounce and close over it, to me, that's on like Donkey Kong. Like I usually get pretty heavily involved on days like this. And if you're in the community, you've seen that where we put a bunch of swings on in this kind of environment. But when I crack below this, so this is whether or not I want to do a swing trade, the 12. The 22 to me is, are the bears in charge or are the bulls in charge? And if you heard this before, apologies, but here it goes. Are the bears in charge or are the bulls in charge? If you're using a 20, you should be thinking the same thing. What good is the line if you don't have some association with it? If you're like, oh, we're there, but what does it mean? You need to look at that and go, how is my trading going when the S&P breaks this? I guarantee that if you're a long-only trader, that when the S&P breaks the 22-day moving average, your trading is not as good as you think it is anymore. Here you're a genius, now not so much, right? Go look at where your drawdowns are. I guarantee it's when you're breaking this. Why? Bears are now in charge of the market for the first time since this started, and since the first time since they paused everything. Wash on. 55 is, do I have institutional support? When you flip the 55, what the market is telling you is you have institutional support. I think you're going to get down here and they're going to test institutional support. Now, let's get into smart money, dumb money for a second. Now, I have a lot to cover with you today, so I do want to go through this because I brought it up and I think it's important. I really want to dive into some of this other, but let's just remember that we don't review this as smart money and we don't review this as dumb. We think of this as institutional versus retail. So smart is institutional and dumb is retail. And that's the way that we're going to think about it. And what I want to just show you is so that we all understand, and this is just going to be one shot that we're going to do this. We can all see how this graph gets to this 0.9, and they changed the way that they're showing this data. And I really don't care for it. I liked it better the other way, but it doesn't really matter. This is what we have. So if we see this 0.9 level, and we know that that is just an outright extreme level that you're probably not going to get to too often with all that froth. What we have to take from these levels is the differentiation of spread between these peaks and what it's telling us. So for example, when we have a situation where you're fully invested on the institutional side and retail can't get out fast enough, which is exactly what you had in April, where institutions were just filling up as much as they possibly could. And what's retail doing? Panicking as much as they have since 22. I mean, they were a mess. What does this do for us when we look at it? So then we go from 0.8, 0.7, and then we break. The break is what's important. Just like with RSI, looking at a 70% level and breaking below that, because that's when you can open up the floodgates. Everybody's fine and everyone's like all hopped up on, whatever they're all hopped up on, their wine or whatever they're doing, those crazy kids today. And down here, just waiting at the 0.3 level is institution. Just saying, we're just waiting for you to puke it out again so that we can load up yet again. And if we look at these levels, does it always work out? Not so much, because we can see right in here that it didn't work out and that actually institutions had to chase and retail crushed it. Why is this important? It's important to realize that this is not always right, and referring to it as smart money and dumb money is not the best way to review this. It's reviewing it from institutional to retail. So there will be times where I'm going to show you an indicator such as this, and you'll be like, oh, well, duh, that, of course I want to pay attention to that. And you're like, oh, I'm going to pay attention to it, and here we go. And then you're going to miss out on the fact that you had a macro piece of data here where Itchy said, hey, by the way, we're not going to raise rates anymore. And that's why we exploded to the upside. And institutions didn't believe them. So the purpose of that is understand what you're looking at and understand it's one data point in the grand scheme of when we're looking at our stool. Yay. All right. Why is it important now? Why did I take a second to show this? Because when you break 0.7, that's when it's on. You can break and free fall, which leads to something like this where you're dropping down and it gets worse and worse. And institutions are in no hurry to bail you out. They're just letting you fall apart. You can free fall down and institutions can be in a huge hurry to buy because they see this as massive opportunity on the way down. And you still might not get bailed out. Why? Retail moves fast. And it's important to understand that that's why you also change the names of these, because you understand that there's two different ways. They have two different personalities. Institutions are a turtle. They're in no hurry. They're pension funds. They're out there saying, oh, well, over the next 10 years, the PE right now here is 15. So if I buy here a decade later, I'm fine. The guy in here, the retail guy out there is trying to figure out why zero-dated options last so long and why they don't have hourly options yet. Right? And so they're out there trying to move around and explain to everybody why zero-dated options are the cat's pajamas. That's an issue because they have a much shorter time frame on the retail side than institutions have, even though the time frames across the board have shrunken a lot over the past decades since I've been doing this stuff. But what is this telling you? You need to be really careful here because if this starts to sell down, it can get really ugly, really, really fast because so far institutions have not stepped up. So in other words, when you're here and you're dropping, note how institutional money starts coming in and saying, oh, well, we'll start picking some things up. Are they doing a darn thing here? Nothing. They're doing nothing. They're actually doing less than nothing. And this is super important. And you can go through any time here and see, oh, we're falling off a cliff. And institutions are like, yeah, we don't really want anything to do with this market. But yeah, that's pretty cheap. And we'll start stepping in. And you can see the inverse in these situations as well. This was actually peak CPI. This is why I always say that you have to look at it in context to where you're at. And that's going to take us back to what is going on here right now. Tariffs, right? On pause, tariffs on no pause, and higher than expected. And is that going to be an issue? The market seems to think right now it's an issue, and you also have the non-farm payrolls data. The important thing to take from this is if retail starts to panic, I don't really see institutions rushing to save you right now or to jump in or to pick the bones yet. Not even close. A matter of fact, they're less interested now than they were 2 weeks ago, if you take a look at it from this perspective. And this goes back to when we were looking at the breadth of the market last Saturday, and people got annoyed with me. So let's go look at that again. Now let's start with the simple breadth indicators here. And in front of us, I'm actually going to have the composite on. And I'm just going to show you the S&P here. But you can see how the composite's rolling over. And I'll show you why I'm going to use the composite in a sec. But what has transpired here? This is the 5. This is the 20. This is the 50. This is the 200. The way I have this set up is that you can actually see the symbols here so that you can go and do this for yourself and you can set your own chart up. I have a copy of this available, I think, on my trading. What's important about this? The 5's at 23. Is that a trough level? No. Trough levels are like 2, 3 single digits. The 20's at 35. Is that a trough valuation? Not throughout history, no. That trough valuation on the 20 is around a 6. We're at 35. So if we're thinking that this is over here, and I'm using the New York Composite right now, it's not over. And I'll show you why I'm using the New York Composite because we're going to tie it to 2 other metrics in a second. The 55, or the 50 is what they use, they should use what they're comfortable with, has broken for the first time. And you're getting a lot of for the first times. And this is a huge red flag to the market. And a huge red flag to institution. Why am I showing this now? Because I just showed you smart money, dumb money. And you see how this is all connected? If institutions see this signal, they're not rushing in until this signal fixes itself. They have no reason to. And institutional order desks look at this specific signal, S5TH. So this is the 200-day. You do not want to break down here. Now, we understand that these are the smaller time frame ones, and we're going to collapse the smaller time frame ones for a second. We're going to collapse the 200. And what I want to do here is I want to open this up. And I want you to take a look at the 50 for a second. Now, if that was a chart and you were charting it, what would you think of that? If you just looked at that, would you feel warm and fuzzy and go, this is something I want to buy? No, you would say, hey, we have a technical break here, and this seems to be heading lower. So more stocks are breaking the 50-day moving average and getting below it than they did on July 15th, than they did on May 22nd. So then what we do here is come down and just look at those time frames and say, well, the breadth of the market on using the 50-day is worse now than it's been in May, then it's been in June, and then it's been here. And you could argue, well, we broke this one. You haven't broken this one. And if we just do, again, the simplest things, I'm trying to keep this as basic so that you can actually use it. But just watch, if you go here and use the bodies, always just use the bodies. And you mark off here from that level. What do you say? From that body to this. We cracked. So you have cracked on the New York Composite, which obviously has more names out there than anything else. There's your 22, and you broke that a couple days ago. Here's your 55. What are you sitting on? Your 55. Why am I using the New York Composite? You need to make sure that you do not close below this. You have not closed below this since May 2nd, since we started getting liberated. Why is this important? Because this is a much broader indication of things to come. So what you want to do is do yourself a favor, and you can use this as another action step, and just go there. Let's make sure we have it right. And just go on it and just click here. And I'm not sure that that's 100% right, and I want it to be right so I don't have to do it again. And just go here and click, and all you do is add an alert to that horizontal line. If you make a lower low and then you remember to go back there, I love alerts because it reminds me of what to do. If you close below this, it's risk off. To me, my hands are already risk off and I'm in short-term trading mode. Just understand where my head is right now. And I want to say something to people. If you can't adapt, there's a reason it's called adapt or die. Like, if you can't adapt to what's going on in the market, you need to stop. If you can't change your opinion about something technical, fundamental, or macro that came out and make a change of opinion on a new piece of data, you have a real problem, and you should not be doing that. I see a lot of people say, well, you said 2 weeks ago. That's the data that I have at that time. You can only work on the data that you have. It's not a function of being right. It's a function of making money. And to think that they're the same thing is where people get delusional. It's not. Your job here is to analyze what's going on and then make the most impactful decision that you can possibly make at that time. And I don't know how to be any clearer about that. So hopefully that makes sense to some of you. But when I crack 50, you want to pay attention. Now, if we go and take a look at the 200 and we look at what's happening here, and we're going to blow this sucker up, what do we say? All right, well, we're not in as bad of shape, but we have a line here and we're starting to crack. And remember, it's 500 names. So if you go from 64 to 53 and you have a 12% correct, well, that means 12% more names are now under their 200-day moving average than they were before, right? I'm just doing the math quickly. What do you care about this? Well, I don't want to break 50. Once you get below 50, it gets kind of goofy and it gets kind of hard. And that's when you'll start seeing these little pullbacks. So please understand that. What you want to take from this is that you need to hold here. On an institutional level, New York Composite needs to hold here. Now in front of us is the New York Stock Exchange, and what we're looking at is the breadth of the market. And what we're seeing is pretty great in detail. And why is it great? Because it's pretty clear what's going on, guys. Now, what are you looking at? You're looking at the advanced decline. That's what you're looking at. Advancers versus decliners. Advancing, decliners. Oh, well, that makes sense. Even here, you got a little bit of a divergence, and you're like, okay, well, that's not great. And what happens when that starts to happen? You just kind of went sideways for a while until it worked it off, didn't it? And when did you start taking out new highs? Well, you started taking out new highs when the advancing started kicking in again. So do you think it's something that you want to pay attention to? Yeah, it is. When you start declining, you really don't need to pay attention to it. What you're looking for is peak declining. That's what we're looking for. And when you have these peaks in declining, that's when you start to say, oh, okay, well, yesterday was peak decline. So that might be it. And that's why always people look at this in a ratio. You always hear them say, oh, it's 9-to-1. It's usually 9-to-1, which will tell you that you're at a peak. 9 decliners to 1 advancer. 9 decliners to 1 advancer. And you get this data from the Wall Street Journal diary. But really, the other thing you can just do instead of netting it out is just go, okay, well, where do we have peak decliners? And that can lead to a bottom. Sometimes, if you're being liberated, it won't. But, like everything else, it doesn't always work, and it's one data point. I would say to use the moving averages as your guide, and then use this as a secondary guide. But you definitely want to pay attention. So we are getting to a level here where this is accelerating to the downside. We obviously see this divergence that we went over last week, what seemed to just ruffle everybody's feathers. And I'm showing it in a different form right now. And now what we want to do is go take a look at something that was giving us an inconsistent result last week and see if it's giving us a different result this week and if we can utilize it. In front of you is the McClellan Summation Index, and this is the New York Composite. So now you can see why we started on the breadth side with the New York Composite, why we tied it to the advanced decline to show you how the breadth is getting weaker. So not only the moving average is breaking, you're seeing the broadening out of the advanced versus decline. And then this summation takes into account the McClellan oscillator, and the McClellan oscillator, this is actually from that. And I like this because this is like turning the Titanic. Like, this takes forever to turn. And when it turns and you don't want to pay attention to it, that's on you. That's all I can do. Now, I do like using the moving average here, but I just want to show everybody something. If I go right into here and click off the moving average and I just leave this out here, and this is how mostly a lot of old school people like it. I like the moving average because it takes so long for it to turn. When it turns, I want to pay attention to it. Now, here I am, and I'm going up. And life is good, and I'm super smart. And then I get this decline here. And so what I'm getting at here is, if you understand how McClellan works in the oscillator, and for time's sake, we're not going to get into all of that. But what you're going to take from this is that for that to turn, it means that you are breaking a lot of levels. And it takes a lot for this to turn. And then this is the indicator for the oscillator. So just think about it that way. For me, breaking zero, if I break zero here, which I would just put a little alert there for you. When you break zero, you want to know. You want to know when you break zero. Now, touches zero and bounces off. Touches, bounces off. Here you have a divergence, and then that divergence was worked off. Once that divergence is worked off and you start pulling back up, that's what you want to look for. So you can see the divergence here, and it doesn't mean, pardon me, don't trade. That's not what it means. It just means understand that this is an issue. Now, the funny thing about this is when you get up to like this 500, I think it's like 500, that you're usually getting kind of peaky. But where can this go to if it falls? Well, these trough valuations from like October 23 or like 1,000. You can see it down here in April, it's 1,000. So how much worse could this get? I'm not saying it's going to, but you have a lot of room to fall apart here, like a lot, if you're using this correctly and you're looking at it correctly. And so what we have to understand is the same thing I'm going to say, and then I'm going to show you some data here that I think is super important in a second. And we need to go through some of these numbers because some of these earnings were fantastic. And people will say, well, how are you saying that the numbers are fantastic and that the market's going to go down? Because you have macro, fundamental, and technical analysis. Macro is what? Fundamental is who is affected by that. Technical analysis tells you when to buy. And I'm going to give you an example in a second here. But for our purposes, in looking at this, we must understand in studying this that this is rolling, this is a divergence, there's your neckline, and you're sitting on the 55. This is the hand that you're dealt. This is it. This is what you have. You can either accept it or not accept it. Now, there are a couple slides that are starting up again, and I think this is super interesting. You have the core CRE loan delinquency trends. I'm going to show you from 07 to 2025, and you can see where we got this from right up here as well. Why do you care about this? Well, delinquencies on 90-day commercial real estate are actually starting to peak again. And it's hard to see in this chart, but it's definitely an issue. Now, when they cut rates, and I think we're leaning that way, that they're going to cut rates, and especially with non-farm payrolls, and we will get to that. I think that this market actually winds up returning and starts to this actually will come down when they start cutting them. That's super important to get, because I think there's an opportunity here in a couple months, probably after September, because I do think they're going to have to cut now. I think they're out of options. We'll get to that in a bit. But I do want to show some things out here that stuck out to me. The loan market bore the brunt, and this is just from pieces of research that I read over the past week. But the default rate on private equity has capital structures that they're made up of loans. The default rate for those loans was 6.6 at the end of June, compared for 4.2 for high yield bonds. So private equity, their debt is actually defaulting more now than high yield bonds. By the end of 25, Moody's is forecasting that private equity debt 7.382 default rate will double the historical average. So what happens when private equity, when something like this happens, is that money dries up, meaning private equity, these guys don't have any money, they don't start putting more money into more projects. Why do you care about this? Because they need liquidity. Where are they going to get liquidity? From the public markets. All of a sudden, you'll start seeing all these IPOs. What did you see this week? We'll get to Figma in a second. You're starting to hear about all these IPOs that are coming out. I think what this is going to lead us to is IPOs are going to start coming out more and more because private equity is going to need their money. No one's going to be throwing money into private equity funds or firms that are double the historic average of the default rate, specifically with the liquidity issues that they have. So they're going to have to go to the public market. And I don't want to spend an inordinate amount of time on this, but we must talk about it. So Tesla, erstwhile ally Elon Musk, increased $300 million in tariff costs. We're doing our best to manage these impacts. We are unpredictable environment on the tariff front. Bottom line are costing this company $300 million. Those pressures extend through the auto industry. Earnings before interest, EBITDA, the quarter suffered a $1.1 billion hit that the Detroit-based automaker net effects of tariffs. To say that companies aren't being hurt by tariffs, it's just not accurate. Carrier Global Tuesday, $200 million offset the impact of tariffs. Whirlpool said North America's sales and earnings were hurt second quarter as Asian competitors rushed to export goods in the U.S. in advance of higher tariffs. So they're front loading it for now. But I do think it's important to get that even guys that are making air conditioners, they're like, yeah, we're going to take a $200 million hit on this. That equates to people losing their jobs. Whether you follow that line of thought or not, the companies are not going to lose money. Companies are sociopaths. They don't care. They have one goal, to make money. If there's something that they could cut that would help them make money, that's what they do. And that's just the way that it is. They're not just going to take one for the team. Procter & Gamble, 2026 guidance, $1 billion in higher pre-tax cost as a result of, say it with me, tariffs on goods from China, Canada, and the rest of the world. Tide, Gillette razor blades expects headwinds, 39 cents per share. 6% decline on core earnings growth from tariffs. Here's the source of domestic and imported taxes or tariffs and goods. Let me just get to it this way. I should have explained this better. This is domestic and imported goods. What you're seeing here is this. These are the people that did it, and this is when it was updated. What I want to show, and what I think super important about this graph, is not only the domestic and the imported, and how domestic obviously is going to drop versus imported, which is the purpose of, say it with me, tariffs. But the hockey stick that's going on here right now, the hockey stick is the thing that we should be looking at, because the hockey stick up is telling us that prices are going higher. Now, the Trump deal with the EU, no matter how you look at it, no matter what you have to say, and we're going to call this video reality, this was a very good deal for the US and not a very good deal for the EU. And when you really dive into this, you'll see it, and that's why the dollar is rising. The rising dollar is causing other sectors like industrials to roll over. I'll show you that in a moment. This is really important to get, because what was working before is starting to come in, hence the breadth of the market and why the market's rolling over the way that it is and getting narrower and narrower, because you had a weak dollar trade that was going on for some time, and that's coming to an end based upon this agreement. This all goes back to when we're looking at the 22 and saying wax off, wax on, and now you understand where. I'm going to follow up with this later in the week, but I do think it's super interesting to see that publicly traded corporations are experiencing net buying from corporate insiders and officers. This is from a company called Insider Sentiment. And I just thought this was fascinating because I wasn't aware of it, and somebody sent it to me. And I did not know that net buying from corporate officers across the board was at 10-year lows. And that's super interesting as to when it's starting to spike down into what we're dealing with here, isn't it? Considering with what we're dealing, because they're seeing the impact. Why are they doing this? They're seeing the impact of what's happening. Now let's take a look at the biggest driver from Friday and what really started this. In front of you is non-farm payrolls, 5 years. And we're not going to spend a tremendous time on this, but we do have to spend some time on it. This is what you've been doing since 21. You've been going down. So it's not like there's this huge shock. But if you drill into it a little bit, I think it's a little worse than people say. And if we go to the 3-year, and this is the point, obviously at this point in time watching it, everybody knows that this lady that was running it was fired. I'm going to just go out there and say that she started January 24, and the 2 worst restatements ever started from January 24 on. Whether or not she has anything to do with it, I don't have a clue. No one really does. But this is really like just a god-awful restatement. Like it's really, really bad. And so we go and take a look at this, and we're all a little jaded by it, and we're all a little cynical, saying that, okay, well, it's this or that. It doesn't matter. These are the numbers. Do I think that somebody made the numbers up? No. I think they were the numbers. I think if you look into how they do this, maybe there was a mistake when you really look into it. Was it malicious? I don't know. I will say this before I go any further. If Jerome Powell had this data, that this is what he was looking at, and this is what you're seeing over the past 3 years, Would he have cut rates? There's an argument to be made here that this is why Bullard and other people have been on the case saying you should be cutting rates, because they were diving into these numbers. I've watched Bullard speak on Bloomberg several times, and that's exactly what his point was, that this is way worse than people think it is. Now, when we look here at the US numbers and we see this, you would just go, well, it's just been trending down. Yeah, this is really bad. And I would be on the side to say that he might have leaned more towards cutting rates had he seen this. Although he has a problem with inflation upticking, which we're not going to spend time on, but you guys know this because you've watched PCE. And we know PCE has gone up the last 3 months, so it's definitely an issue. What I do want to point out, and what I do think is important, is Jerome looks at Jerome, like I talk to him on a first name basis, but Powell looks at it as 3 months in a row. And I just want to say that here you are on a 5-year chart, you're looking at manufacturing, and if we take a look at the last 3 data points, they're all negative. So whatever we're supposed to be doing here, this is what we have. And I'm not saying that this isn't erratic and we're not all over the place. We are all over the place with these numbers. But the last 3 in a row, they're down since this started. And you can literally count it out with me and say, May, June, what? Why are they doing this? Because they're prepping for it. If we look at private payrolls, we can just see, again, you start at the high and they're low. And people say, well, it's not as bad. Well, if you go back to 24, these numbers are roughly 160, 170. You got a 220 here and there. These are 60, 70,000. Like this is pretty much some of the lowest readings that you've had in years because everybody's in wait and see. But I do want to just point something out because people are like, oh, they do this all the time. I'm not saying they do or they don't. That's not where I'm going with this. When we had here, let me do it this way so that you can actually see the headline. When we went through this before, one of the key things they kept doing was they just kept hiring at the government. And we did this in 23. A matter of fact, if you look over 10 years and you just kind of go from here and you look at the sector, that's just, the economy's great. And that was 23 to 24, even though we were losing regional banks. You had the single greatest growth ever in government payrolls than you had going back. If I max it, it goes back. I just stopped at 10 just to max it, just to show you. But you never had growth in government payrolls like you did between 23 and 24. Why does that matter? Because that should really be what's unwinding, and that's not. So it's all doom and gloom, right? No, it's not. And what you have to understand is that this will be a pullback of some kind. It will be a turnaround of some kind. But what will happen is there will be a pullback. It will be a correction. It'll be something that someone else will name. And it's up to you to go out there and figure out what you're going to do with it. For me, what I tend to do with these environments is I look at the stocks that absolutely crushed. Like Microsoft, it's unequivocal. If you go through this quarter, they absolutely destroyed it. Meta absolutely destroyed it. That's not going to stop because the market comes in. And when you look at something like Meta, you realize you're still at all-time highs, even on this pullback. What we have to do is just be cognizant of this and then start looking at the names that we're interested in. For me, on these pullbacks, I have a list. And going through that list is what's going to make me money. And so what I would say to you, whether you're looking at some of the same names that I am, like a Meta or a Microsoft, which absolutely, again, crushed earnings, or you're going to say that I'm interested in Apple, which I get because you're at that 200 put level, which you tend not to break, or you're looking at Tesla, which can't really break that 300 level every time it goes under it, where that's what the put wall is, wink, wink, nudge, nudge. If you're looking at stuff like that, yeah, you want to pay attention to it. But overall, you have to ask yourself about some of the secondary stuff that you're looking at. Are you willing to ride those themes? Like, for example, did the nuclear theme change because of tariffs? Probably not, right? Probably not. Okay, so we broke the 22 there and then we bounced over that theme. Well, that's interesting. Is that what the market did? Okay, so in other words, we're finding themes by going top down, and we're finding themes that are actually holding that level. And remember what this level is saying to me. This is, do I want to swing trade it? This is telling me who's in charge, or the bulls and the bears are in charge. This is telling me that the bulls are in charge. So if I start going through my sectors looking for ideas like that, and I see that financials are below the 55, well, that might make me put the brakes on, right, for financials. Or if I look at the SOX and I see that the SOX broke the 22 the day before, and now we might be holding here, well, that's something as well. So then I might drill into like the big names like a NVIDIA and take a look at those and say, well, did that break? No. Okay, so if something broke and then I want to go take a look at the key levels, maybe what I do is then go find what names they are. I'm looking for the leaders and I'm looking for the names that are holding above their 22. I would suggest that you do the same. That's it.